You filled out the application. You had a decent score. You've been with that bank for years. And the answer came back no. No explanation that made sense. Just a letter with vague language about creditworthiness and a list of reasons that don't quite tell you anything useful. Here's what almost nobody explains. Your credit score is only one part of what a bank looks at. There's an entire second layer of evaluation happening that never appears on your credit report, and most people who get denied never find out it exists. Tonight, that layer gets explained. What banks actually see when an application crosses their desk, why two people with identical scores get different answers, and what can be done about the parts that aren't on any report you've ever pulled. The first thing to understand is that a credit score is a screening tool, not a verdict. When an application comes in, the score determines which pile it lands in. High enough, and it moves forward. Below a certain threshold, it may be declined automatically. But between those two extremes sits a large middle zone where the score alone doesn't decide anything. It just opens the door to a closer look. That closer look is where most denials actually happen, and it's evaluating things the score was never designed to measure. A credit score answers one narrow question. Based on past behavior, how likely is this person to repay borrowed money? It doesn't know income. It doesn't know employment stability. It doesn't know how much is already committed to other obligations each month. It doesn't know what the bank's own records show about the applicant's history with that specific institution. All of those factors sit outside the score, and any one of them can produce a denial for someone whose score looked perfectly acceptable. The single most common reason for denial that has nothing to do with credit score is debt-to-income ratio. This is a straightforward calculation. Total monthly debt obligations divided by gross monthly income. If someone earns $5,000 a month and has $2,000 in monthly obligations, housing, car payment, student loans, credit card minimums, that's a 40% debt-to-income ratio. Lenders have thresholds, cross them, and it doesn't matter how perfect the payment history is. The math says there isn't enough room in the monthly budget for another obligation. Here's what makes this frustrating for applicants. A person can have an excellent score precisely because they've been managing a lot of debt responsibly for years, every payment on time, never missed one. And that same debt load is what triggers the denial. The score rewards the behavior. The debt-to-income calculation penalizes the volume. This is also why paying down balances before applying matters far more than most people realize. It doesn't just improve utilization on the credit report, it lowers the monthly minimum obligations feeding into that ratio. Now the layer almost nobody talks about. When someone applies at a bank where they already have accounts, that bank is looking at its own internal history with that customer. And that history is invisible on any credit report. What lives there? How often the account has gone negative? How many overdraft or non-sufficient funds occurrences have happened? Whether deposits have been returned? How long the relationship has lasted? Average balances maintained over time? And whether there's ever been a loss on the account. None of this appears on a credit report. A person can have a spotless credit file and a troubled internal history at the institution they're applying to. This creates the situation that confuses people most, getting denied at the bank they've used for a decade while getting approved somewhere new. The new bank only sees the credit report. The existing bank sees the credit report plus everything else. There's a related system worth knowing about. Banking history, closed accounts with unpaid negative balances, suspected fraud, repeated overdrafts, is reported to specialized consumer reporting agencies that track deposit account behavior specifically. That's a separate topic worth its own discussion, but it's part of the picture. Some denials have nothing to do with financial behavior at all. They come from the application. Inconsistent information is a common trigger. If the address on the application doesn't match what's on file with the bureaus, or the income stated doesn't align with what verification shows, or the employer name is entered differently than in prior records. These mismatches raise flags in automated systems. They're often innocent. They still slow or stop applications. Recent inquiry activity matters too. Multiple credit applications submitted in a short window signals potential distress to underwriting, regardless of intent. Someone shopping for the best rate looks similar in the data to someone urgently seeking credit anywhere they can get it. Employment gaps or very recent job changes can affect certain products, particularly larger loans where income stability is central to the decision. And thin files, meaning very limited credit history, can produce denials even with no negatives at all, simply because there isn't enough data to evaluate. Here's the practical part. First, the adverse action notice matters more than most people realize. When an application is denied based on credit information, federal law generally requires the lender to provide notice of the principal reasons. That letter is often skimmed and discarded. It shouldn't be. The listed reasons are the actual factors that drove the decision, and they point directly at what needs to change. Second, if a denial was based on credit report information, there's typically a right to obtain a free copy of that report from the agency used. Pulling it after a denial is worth doing, because sometimes the denial traces to an error rather than actual behavior. Third, the reasons themselves suggest the fix. High utilization means pay down balances. Insufficient credit history means build over time. Too many recent inquiries means wait before applying again. Debt to income issues mean reduce monthly obligations or increase documented income. Fourth, and this is the one people skip, many institutions have a reconsideration process. A denial from an automated system is not always final. Calling and asking for the application to be reviewed by a person with additional context provided sometimes changes the outcome. It doesn't always, but it costs nothing but a phone call. Fifth, if the denial came from a bank where there's an existing relationship, applying elsewhere may produce a different result. That new institution doesn't have the internal history. This isn't gaming anything. It's simply understanding that different lenders see different pictures. A denial isn't a judgment on a person's worth or even necessarily on their credit. It's the output of a specific evaluation using specific inputs at a specific institution. The score opens the door. Debt to income decides whether there's room. Internal history at that institution colors everything if the relationship already exists, and the application itself has to be clean and consistent to survive automated screening. Read the adverse action notice. Pull the report it was based on. Address the specific reasons listed. Consider reconsideration. And understand that a no from one institution is not a no from all of them, because they aren't looking at the same picture. The system feels opaque because nobody explains it. Now it's a little less opaque. This is Credit Clarity. We'll see you in the next one.